Hi, I'm Michael Yardney, and in great news for those interested in property investment, and another blow to the property bears. Yes, they're still out there waiting for the sky to fall. Anyway, good news is that capital city dwellings rose a further 1.8% in July, according to RP data. However, despite the fact that cumulative recovery in residential markets since the market bottomed last year has been about 6.5%, this property cycle is likely to be very different to past ones, one where capital growth is going to be a little bit lower. In fact, most property commentators agree that we're unlikely to see that sort of housing boom that sparked the massive rise in personal wealth last decade. This has had many investors asking, well, what's the right strategy this time round? Let's have a quick look at how property investors make their money in property. They do it in four ways. Firstly, through capital growth. That's the increase in the value of their property. Number two is through rental returns. That, of course, provides you with cash flow. The third way you make money in property is with tax benefits like depreciation allowance and negative gearing. And the fourth method is what I call forced appreciation. This is where an investor manufactures some capital growth through renovations or development. Of course, strategic investors benefit from a combination of all four of these. Okay, well, can you still get capital growth? The answer is yes, you can. RP data recently reported that our capital cities did very well over the last 12 months. Perth values increased 8.3%, Sydney 6.5%, Melbourne 4.3%, Hobart's values only grew 2%, Canberra 1.1%, Canberra 1.4 I should say, Adelaide 1.1%, Brisbane grew 0.8%, and Darwin values dropped a bit, about 0.9% over the year. But these figures really don't tell the full story. In all our states, our markets are very fragmented. There are some pockets that have significantly outperformed the averages, and many have underperformed the averages. If you dig deeper, you'll find that in most states there's a group of suburbs that exhibited double-digit capital growth last year. And within those areas, there'll be some properties that grew strongly, while others performed poorly. Of course, that's just how averages work. So where do you find these properties that are going to outperform the market averages? In many cases, they're in areas that are going through gentrification. Suburbs where a new demographic has moved in, spending large amounts of money on renovating or extending their homes. You'll also find stronger capital growth in suburbs where wages growth outpaced average wages growth, meaning that the locals can afford to pay more for their properties. But some people are saying, well, what about positive cash flow? Of course, a positive cash flow property is one where the rental income covers all the property's expenses, including interest, leaving money in your pocket each month. Unfortunately, in Australia, properties with higher capital growth have lower rental returns. This means you can't find cash flow positive properties in higher growth, better locations, especially in our capital cities. You must look more to regional areas and mining towns where buyers are prepared to forego higher capital growth so that they can get a higher rental return. Of course, you could lower your loan-to-value ratios, borrow less, and that way putting more money in the deal, you're going to get positive gearing. The problem is, of course, if you do that, you miss out on the benefit of leverage. So, at this stage of the cycle, or in this property cycle, which strategy is better, capital growth or positive cash flow? There's no simple answer. Clearly, if both strategies exist, there's a place for both of them. I see more beginning investors going to cash flow positive properties. On the other hand, I tend to see more successful investors, those who build a substantial asset base, grow their portfolio through leverage. They leverage off the capital growth of their property investments. In my mind, property investment's got to be part of a wealth creation strategy, not just a purchase in isolation. So if you're considering property investment to build a big asset base to one day replace your personal exertion income, then I'd invest for capital growth every time. A few dollars a week of positive cash flow won't make a difference to your lifestyle, and it won't help you service your other debts or buy more desirable properties or get the deposit for your next property. Interestingly, best-selling author Steve McKnight, who became renowned for writing a book on how he built a very substantial portfolio of positive cash flow properties, explained in his last book, he called it From Zero to Financial Freedom, How to Do It Today. He explained that the strategy of buying cheap cash flow properties no longer works today. The problem is you can't save your way to wealth, especially on the measly after-tax positive cash flow you get in today's property market. And when interest rates increase, and they will one day, a property that's currently positive cash flow could be negative cash flow tomorrow. If you think about it, real wealth is not derived from income. It's achieved through long-term capital appreciation and the ability to refinance to buy further properties. If you seek a short-term fix with cash flow positive properties, you're going to struggle to grow a future cash machine in your property investments. It's as simple as that. But here's the trick. You can't turn a cash flow positive property into a high growth property. You can't because of its geographic location. But you can achieve both high returns, cash flow, and capital growth by renovating or developing high growth properties. This will bring you extra rent, give you extra depreciation allowances, and it will convert high growth, relatively low cash flow properties into high growth, strong cash flow positive properties. This means you get the best of both worlds. So that may have you asking, well, how do I cope with negative cash flow? Of course, one way of doing this is to set up the correct loan structure, a line of credit or an offset account that you could use to supplement the rent to help pay the interest on your investment properties and your expenses. If you do this, this will buy you time. A line of credit is often set up to cover the shortfall for a few years of your property until it increases in value so you can refinance the loan out of your extra equity. To use this investment strategy, correct asset allocation is critical, because to make it work, the property's value needs to increase significantly more than the outstanding loan balance increases if you're going to use your loans to cover your negative gearing. This means you need to be investing in high quality assets so you can maximise the chances of enjoying strong capital growth. Of course, this strategy isn't without risk. The four main risks to me are the lack of capital growth. That's why correct asset allocation is important. Rising interest rates, but this can be addressed by fixing your interest rates on some or all of your debt. The third risk is if you don't get much rental growth. Of course, this again highlights the importance of choosing the right asset, a property that's going to be in continuous demand by a wide demographic of tenants. And the other big risk I see is lack of financial discipline. See, I've seen people use their financial buffers for all sorts of things rather than covering their property. They take holidays, they buy jet skis. This is a good strategy if you have the discipline. So in summary, I can understand why beginning investors are keen to buy properties with positive cash flow. They tend to be cheaper to buy, easier to purchase, easier to support. While they may give you short-term income, these properties will never allow you to accumulate the equity necessary to become truly wealthy. And while the rents may seem relatively high initially, it's your ongoing capital growth that will underpin long-term rental income, which means if you buy in low capital growth areas, your rents won't rise anywhere near as much as the rents will rise in a high growth area. Over the long term, the value of your capital gains are going to outperform those areas where cash flow is a little bit higher to start with. Remember, as a property investor, your focus should be on safely building your asset base so you can eventually develop that positive cash flow, that income that will allow you to enjoy financial freedom. I'm going to show you exactly how to do this if you join me at one of my upcoming seminars I'm conducting around Australia, my upcoming property market and economic updates. Go to the website propertymarketupdate.com.au to get full details, or click at the link on the bottom of this article. Look forward to seeing you there.